Good afternoon, everyone. Welcome to today's webinar, Mesch Method to Trading Market Profile, Putting Your Strategy in Context. Today's presenter is Robin Mesch, President of Mesch Capital Management. Welcome, Robin.
Thanks, Tom.
My name is Tom Hartle. I'm CQG's Director of Product Training. I'll be your host and moderator today. Before we get started, I want to mention a few housekeeping items. If you have any questions during the webinar, please enter them into the Q&A section window at any time during the presentation. We'll have Robin answer the questions at the end of her presentation. If you are viewing the presentation in full screen mode, you can find Q&A in the WebEx toolbar at the top of your screen in the drop-down menu on the far right. If you're having any sound issues, please contact the host via WebEx chat. We'll be recording today's webinar, and it will be posted within 48 hours to the events section on news.cqg.com. All registered attendees will receive an email with a link to the recording. Now, I'm happy to introduce our guest presenter. Robin Mesch has been building innovative market models for more than 25 years, and today is considered to be one of the world's top minds in technical analysis. Her market strategies are incorporated into financial portfolios by some of the leading investment firms and trading houses. Ms. Mesch is a regular guest on CNBC's financial segments, and her unique approach to the markets has been included in numerous books and publications, including Breakthroughs in Technical Analysis, New Thinking from the World's Top Minds, and New Thinking in Technical Analysis, Trading Models from the Masters. Welcome, Robin, and now we'll turn that webinar over to you.
Okay. I appreciate everyone showing up today. Thanks for coming. Today's workshop, I'm going to be showing you how I organize and interpret market profile charts. I think we all can agree that if there's any form of analysis that's going to be effective, it has to translate into some practical application for our trading and our investment. So ultimately, that means being able to use it to build and execute a trading strategy. So today what I'm going to show you is how I use this tool called Market Profile to create these contexts for my buy and my sell strategies. Now, what we're trying to accomplish with technical analysis really is to structure our perception so that we can see these patterns and we can start to discriminate between these random market activity and non-random market activity moments. And so really one of the starting points to imposing structure on the market at the base level is how do we represent this data? And way back, just imagine if you really had to trade off a list of prices instead of a bar chart. And so this bar chart is already facilitating for us these really important patterns in the market. Now, if any form of analysis is going to be effective, though, it has to take into account all this information that's being generated by the marketplace. And most technical approaches really only focus on price. And this is essentially leaving out quite a significant part of that market information that's available to us. And what you're looking at here, this is a monthly price bar of the S&P 500. And so from this form of data organization, you really have no idea whether any price within this range is considered more fair than another. And you also don't have any idea where this market's going to go from here or when that would happen. So what if we organize this exact same monthly bar in terms of how much time a market has spent at each of these various price levels? And would we be able to answer these questions? So let's just take a look at a market profile chart of this same period. So when we organize the same monthly bar in terms of how much time a market has spent at each of these various price levels, this format really allows us to quickly see that, in truth, not all these price points are considered equal by the market. So the market profile chart to the right clearly shows that this is true. There are dimensions of information stored in this bar chart, but really as a price bar, it wasn't accessible to us as traders. So what we're going to talk about today is how time spent at price is really far more informative than price alone, because it tells us, first and foremost, the market's perception of value through participants' willingness or their unwillingness to use price. Bottom line is, the theory here is the more we use price, the more we come to accept that price is fair. Usage converts price into value. I think we can all have an experience of this. I think the idea of usage of price is far more relatable a concept than this time spent at price, because usage is this unmistakable reflection of a trader's psychology of acceptance as a price being fair. If you don't think it's fair, you're not going to use it. And so here's an example. This is Chicago gas prices, and you can see the first time gas started climbing over $3.40 back in 2007-08, it was met with this psychology of rejection. We all felt, oh, this is totally unfair, to the point where people began really changing their behavior in order to use that, not use that commodity. And now what you see is this initial psychology of price rejection has kind of been displaced with the psychology of price acceptance. See over to the right. Now, we're not only willing to use gas at $3.40, but as it comes down to this level, we're enthusiastic if we can get it. So bottom line is, how do we structure the market so we can start to track this process in which price gets converted into value, and then ultimately it gets accepted through usage? So first and foremost, we have to organize the data in a way that allows the trader to track that progression of perceived value from unfair to fair. So before we get started, I want to emphasize from the start that market profile isn't a technical indicator. It's a database. It's an alternative way to represent this data that accounts not just for price, like a price bar, but it also reveals to us how much time is spent at any given price. And so we're going to see how time spent at price is really far more informative than price alone. Now, in today's talk, there really isn't enough time to cover in too much detail how market profile is constructed, along with a lot of the beginning concepts of market profile. But so if you're interested, refer to my chapter in Breakthroughs in Technical Analysis. That was published by Bloomberg Press. There are lots of other books on basics of market profile. I thought what I'd talk to you a little bit about, just in terms of the profiles we built for this presentation. They're created off a daily bar chart for the most part. The profiles of daily bars are constructed exactly the same way as these intraday profiles you're perhaps used to using and creating in the CQG platform. But it begins here with every day's range associated first and converted, say, into a letter. In the representation to the right, the profile is called a split profile, and you can see each day's range is now represented as a letter. And these daily splits are what we often use as hour-based charts to create these larger contexts for the weekly or monthly profiles that I use. Now, once the price ranges are converted to letters, the profile is created by moving each vertical column as far to the left as possible. And then the prices where the letters start to overlap, now they have two letters in their rows, etc. But if a column of letter makes a new high or a low beyond the current range, it's going to be placed to the furthest column to the left. And so as we continue with the rest of the letters in the same way, what you can see is that width is beginning to build up in the rows where the same price occurred in multiple daily time periods. So the fattest part of that profile shows the market has spent the most time at that price. Now, when we depict that auction process in terms of time or usage at a given price, we're going to see it naturally organizes itself into a bell curve. And the bell curve emerges as a reflection of consensus between those buyers and the sellers at the moment they've determined fair value. And the real strength of market profile analysis, and what we're going to emphasize in today's talk, comes from reorganizing the profiles to complete those cycles of market activity. And by that, I mean the completion of this bell curve. So for instance, if we organize this annual price bar on the left into the components of building fair value, moving away from fair value, as opposed to constraining the data by time, we would have organized the data into the profile displayed on the right. What we would have been expecting a new directional move at the end of October, once that bell curve was complete and consensus was reached by the market. So the fact that the auction naturally organizes into a bell curve allows us to apply some of the bell curve's basic statistical principles that are really helpful to trading. And so for today, and what I use are really just 3 key areas of importance that we're going to focus on today. The mode, which is this highest usage line or the fattest part of the profile. We're going to focus on the value area, top and bottom, which the way I use it, I just include the first and second standard deviations of that bell curve. And then the auction top and bottom. So if it's valid and sustainable, it really should be single prints. If that auction was shut off, then you shouldn't see double prints. Multiple print highs and lows, they're usually early warning signs that the buying or selling wasn't shut off. And eventually I see those multiple print highs or lows taken out pretty much in the near future. So let's see how those phases of developing the bell curve dictate a trading strategy. Now when that bell curve isn't fully developed, like the one on the left, it tells us that the auction process isn't complete. That bargaining process and negotiation still going on. But when it's complete, like the one to the right, I call it ripe, ready to move directionally and seek a new area of value. So the picture on the left is the market still under negotiation, hasn't reached consensus. On the right, consensus is complete, market's ready to move directionally, and you can see the bell curve's completion has really tracked this process because out of that mode, it starts to move directionally. So here's another example, same idea. Development, consensus building, determining value. This is all still underway on the left-hand chart. Once consensus is reached, the bell curve's complete. That's what we see on the right-hand chart. The market's ripe to move. Now, these 2 profiles, they really dictate very different strategies. So during the phase of development, we can play for range trade at the bottom and top of value of the building of the bell curve. Acceptance of value is this completed bell curve, and it's really at that point, your strategy needs to change, and it needs to change toward looking for this new directional force. This is where people really get into trouble. They continue to play for range trade in this consensus moment, and they get hammered. So playing for range, it's a very risky strategy at the chart on the right. So what we're going to cover today is really a practical approach to using market profile to recognize the underdeveloped bell curves, trade within the range they establish until they're complete, establish a larger context for clarifying the next directional move. That's how simply we're going to work with this data. So let's just do a quick summary of what we've covered so far. The beginning of the auction represents that determination of value. The completion of the auction is going to mark acceptance of value, and market consensus looks like a completed bell curve. So the fact that that auction naturally organizes into a bell curve, it really helps us know how to better organize the data so we can bring these developing profiles into the forefront of our trading. So let's talk a little bit about how we organize that data. It's always the big question, how do we track this auction cycle, and how do we find this readiness? So I call it clock time versus market time. And using those profiles in their default organization, like uniform time periods of days, weeks, or months, it's really not the best strategy and the best way to track the progress of the negotiation process. I like to combine profiles to bring out the bell curves. And so this is what's called true market time. And so whatever time it takes by the market participants to reach consensus in terms of value is how we need to organize that data. So, but how do we know what data to combine? And the real strength of market profile analysis comes from reorganizing the profiles to really reflect these complete cycles of market activity. And I typically combine profiles that are building within the same value area until that bell curve comes close to completion. So when the bell curve is nearly complete, I have to start putting that profile into a larger context to determine where it's likely next going to venture to explore some new value. So let's preview our approach looking at a reorganized version of this very same data and showing a complete auction cycle followed by a new directional move. So on the chart on the right, that data is no longer organized by uniform time periods. It's organized by the market cycle of completion of the bell curve. And this final version is created by combining all the monthly profiles from Feb 2009 to April 2009, and then May 2009 through April 2010. And this provides a structure and a presentation of the data that we're going to see gives us a real basis for determining the strategy when trading any market, or really any time frame. So let's take this to the next level, which forms the basis of my models and my trading style. And this is my thesis. The key to anticipating the directional move out of a completed bell curve is the principle that markets move from high usage to low usage areas, and they're in this constant process of integrating current value with past value. So the way I trade market profile is I'm constantly looking to conjoin completed bell curves. And this helps me to create a context for where that next phase of development is going to unfold, and it helps me determine the next directional move out of that current bell curve that's under construction. So you can see the new directional move of profile C came right out of the mode of profile B and headed to the top of the trading range that's being contained by the historical mode of profile A. So here's an example of XLE that you see on the left. A number of monthly profiles occurred, but in reality, they're really all part of that same development. And you can anticipate a broad trading range for pretty much close to 7 months until that larger bell curve was complete. So these profiles, they're all organized by time on the left, and they don't really highlight the completion of that bell curve or the readiness of that market to move directionally until we bring them together into this composite profile we see on the right. And it's at this point of what we call consensus. We want to start to get this profile into context. We want to put it into context of development of a bell curve of really a larger scale to determine that next directional move. So let's see what happens. Here we've taken that bell curve of A, of XLE, and we've traded it during its development construction. And now we have to put some context in it, and we look back, and we go all the way back to July 2009 to determine some context. If we conjoin the two profiles, A and B, on the left, what you see is what we call a pocket of low usage. And this pocket is separating these two high usage areas. Low usage in this context rests at the center area, and it's connecting these two completed profiles. And so once they're combined, we can see that there was really very little trading between 60 and 72. This is actually what we call a really deep pocket of low usage. It's what I scan my charts for. The deeper the pocket, the better the move, the faster the move through the pocket. So if our theory is correct, by combining prior development, we see the pocket of low usage rests below that completed bell curve at A. And so we know that the more probable new directional move is going to probably initiate to the downside and make a larger bell curve out of the data going all the way back to 2009. So that's the theory. And you can see what expected unfolded. Breaking that ledge at 72 triggered that quick decline to the bottom of the low usage pocket. And that's also very typical of market activity, is that the new directional move, when the bell curve's ready, it'll initiate out of that highest used area or the mode. And that break between that low usage pocket was pretty fast, and then what you can see on the next slide, that pocket of low usage kept the market contained in that trading range for 9 months until that larger bell curve was complete. So it created the new trading range. So what we'll see, this core pattern, we are going to see this pattern play out again and again and again, where these low usage areas conjoin two distinct areas of consensus, and then market activity proceeds to knit them together into one fully developed bell curve. So here's a snapshot of cocoa. We see at the end of July, the development of the bell curve at A was complete. It was ripe, ready to go. We need to bring in history to provide a context for determining that next phase of development. When we conjoin the two bell curves, A and B on the left, what do you see? We see this pocket of low usage that separates the two high usage areas, and we see the close at A at the bottom, and we're thinking, okay, strategically, the new directional move is, one, likely to be to the upside, confirmed on a move over the ledge of high usage at 2370. And my target's probably the top of the pocket, which is around 2770. And this is a recent move that we've been tracking. This has been happening in cocoa. What was expected unfolded. Breaking above the ledge of high usage at 2475 triggered that rally to the top of the low usage pocket. And again, typical of market activity, that new move happened right out of the mode, or the highest usage area. So let's just take, before we get into this trading strategy, let's just take a review of this fundamental cycle of market activity. So this is what we've covered so far. The cycle of market activity is when the market completes a bell curve. Once the bell curve's complete, there's a whole new directional move begins in search of either a new value or we'll explore some prior underdeveloped value areas. In order to anticipate that new direction, we need to put the complete cycle of market activity into context of a larger incomplete cycle, and then we look for where those low usage areas exist that either are above or below that completed bell curve to tell us the next directional move. Now, our whole style of trading is going to change based on what phase of market activity is in place. So if the market's constructing a bell curve, we need to have a range trade mentality. If consensus is in place and the bell curve is fully developed, we have to start thinking about direction. We have to put that market into context in order to determine what that direction is going to be. So I want to use a couple examples today to make sure we all recognize this fundamental cycle, and then we'll start building this trading strategy notion. I brought two examples, E-mini and the yen, because they're so similar. This is a bell curve pattern I see all the time. When you look at A without any context, it would have been really difficult to predetermine the new direction that was going to initiate on August 10th. But if you put that completed bell curve in context of its underdevelopment, you see behind it are these pockets of low usage peppered throughout that profile. So we know that we had a potential decline, that we were either going to go to 1094 or 1068, that we were going to be wrong if it goes over that ledge of high usage above A profile that built. One thing you can count on when you are playing for a new directional move, when the bell curve's complete, typical of directional move is thin profiles, fast speed. So if you start to get what you think is going to be a breakdown and you're trading sideways, your idea isn't unfolding as it should. Usually a break of a ledge should trigger fairly substantial quick move, especially if that pocket's deep enough. Here's the yen. This profile pattern occurs time and time again, so I wanted to bring you two examples side by side. We put the completed bell curve of A in the context, and so take a minute, and I want you to think about what your strategy is going to be. So one, is that chart on the right a completed bell curve in its entirety? No. Are there pockets of low usage? Look at the close at A. Now, are the pockets of low usage above you or below you in that current development? They're below you. And so what's your expected direction of this at this current price point? The answer you should have is it's going to go down. And so where my pockets are, I might take a rest at 2450. I might build that section out at first. This is a pretty protracted composite profile, so sometimes things will happen in segments. But ultimately, we could get a move all the way down to the lowest usage area, like 1130. So what you can see, that's the market moved in those stages. They moved from high usage to low usage, spent some time organizing into that bell curve, the upper pocket. Once that was completed, the whole cycle starts again. New move, I know when D is complete, my bell curve's complete, something new is going to happen, anticipating it to be to the downside, and the market breaks to the next ledge of high usage. So this was actually a chart in both charts, the one before and this one, that before they were complete, I brought to a webinar and another workshop, and the audience was able to get that after we had completed this course, they knew that this market was going to go down eventually to 1130 based on just this theory. So how do we use this principle that markets are going to move from high usage to low usage to build our trading strategy? And so these are our principles. One, we're going to range trade underdeveloped bell curves until they're complete. Two, once they're complete, we're going to conjoin completed bell curves into larger underdeveloped contexts. So basically, we're always playing underdevelopment. And three, we're going to trade for development of low usage areas until the larger underdeveloped context is integrated into a completed bell curve. So it may sound simple. It is, actually. So let's just start by looking at the market profiles currently, some that are currently under construction. I brought the dollar. So this is a snapshot of the U.S. dollar in early September. And these are the things you want to ask yourself when you come to any profile. Am I going to be directional, or am I going to be in trend or consolidation? Trend or consolidation, what direction? What's my target? How long will this strategy be effective? And how do I know I'm wrong? What's my plan B? So if you were looking at this, the first thing you want to tell yourself is this is an underdeveloped bell curve. I'm going to play for range trade. Second thing is you say, where am I located? Oh, I'm at the bottom of value. The key levels you want to position yourself in a developing, underdeveloped profile is at the top and bottom of value. Typically, you can probably, if you bought the bottom of value, you could probably high probability get to the mode. You'd have to use your own technical filters, I think, is what I do, to determine if I'm going to exceed the mode and get to the top of value or not. But in this phase, top and bottom of value are your key trade locations. Also, this is probably not an environment that's going to escape value because the consensus is so low. So I wouldn't be wanting to take a breakout strategy in this background. And this is really the kind of context you're going to see your breakout be breakout failures typically. And what we see is for nearly 6 to 7 weeks, this strategy stayed intact. And the opportunities for buying and selling that top and bottom of value, they were prime real estate for a minimum return to that mean. Now, at this point in the cycle, you cannot continue to play range trade. And this is also where overstaying your welcome in congestion trading is going to get you into trouble. Because toward that end of the building of the bell curve, you have already had to put this profile into context and have a sense as to what that next high probability direction is going to be. So let's do that. Let's put this A into context. And so now what? So here you are, you're sitting at the mode of A, and you look behind you in context, and the pocket of low usage is above you. So you can create a number of scenarios here, but in terms of trade location, if at this point you're still holding out for the bottom of value, good luck. You're probably not going to get it. You have to come up with, at this point, a strategy to either buy a breakout over the ledge or find some information about the order flows at the mode to give you a clue as to which way this is going. Not only which way this is going, because you have a high probability it's going up, but an entry trigger that you can handle the risk. So if you've waited at this point, typically a move over that ledge of 80.30 going to mean I'm going to head to 81. And then I'm probably going to range trade within that pocket, and that's my next step of development. And when we have such a deep pocket of low usage, it's really an ideal trading environment because that move to the target usually happens pretty quickly once it gets underway. And then you see that cycle begins all over again at C. So see how it just spent time developing a new profile. Now it's ripe and ready to move again. Let's do the same idea with gold. You may have seen a couple of my other presentations. I use gold every time because I am continuing to update it. Each one of these slides are slides that I brought at points of different presentations so that people in the audience could really predict using the theory what's going to happen. So if you look at this, what's our strategy? Are we going to have trend or congestion? The question is this a completed bell curve? Answer is no. So I'm going to play for development. This is going to be a range trade strategy. I want to buy the bottom of value. I want to sell the top of value. Basically, anywhere between 1775 to 1825 is prime real estate. This was a major uptrend at the time. 1550 was a gift if offered. And you can see this range held, I mean, it had a pretty long duration because the initial range that was set was so huge, and that often dictates the duration of your trading strategy. So back and forth, you're selling 1770. It's a much better idea to be buying 1550 and selling 1770 for range trade at the beginning. Once we get to August, you better have a very good idea what's the next direction, because it's those points where your trade location is going to be the best for anticipating a new directional move. And so around August, I would be putting that bell curve at A into some kind of context to start positioning myself. So after 16 months of development, this market's ripe and ready to move. And this is actually the chart I brought to the MTA conference, and the people in the audience said, okay, well, we're coming out of that mode at A, and if markets move from high usage to low usage, it's going to go to 1425. And they did a great job because the idea was to keep selling against 1780 while the market was developing, look for the break to 1425. And if you waited till that mode was complete, you'd probably have to wait till the break of the ledge at 1550 for a swift move to 1425. Now, you should recognize this profile by now to the right. That is what the E-mini looked like. That's what the yen looked like. This is a very typical profile. As you start to bring in more and more data behind you, you can start to see the magnitude and the potential of the breakdown of some markets, especially in gold. So when that market was at 1550, we thought, oh, maybe it could get to 1425. As you start to bring in more context, you realize this is a macro change of direction in gold, and this could easily get to 1250, potentially, and overall, my long-term downside target is 950, which is probably the big buy opportunity in gold if when it gets down there. At this point, you might see some development in the current range, and the next breakdown of 1100 is apt to take us to 950. And this is how the market's unfolded to date. We broke out of that 1550. We spent a little time at 1425 and then built a little tiny bell curve in most of our time frames, and then initiated again and broke to 1250, and that's what's been containing the market. You can see right now, gold's ripe and ready to move again. And if you have the opportunities to sell toward the top of value, you want to position yourself for the ultimate decline much lower in gold. So we're about 30 minutes through. I want to have a couple more examples. This is the current outlook for the 30-year. By now, you should all be pretty good at recognizing what your trading strategy is supposed to be here. And at this point, you're probably thinking, I'm going to trade for range trade. If I could get 151, I'd sell it. If I can get 145 to 44, I'm going to buy it. Once I start completing my bell curve, I have to put this thing in context. I'm already seeing the context behind me. So ask yourself, what are you going to lean on towards the end? Which side of the range are you going to lean on at the end or toward the end of the development of this bell curve? Hopefully you're saying the sell side, because when you put this, when you look at A, you kind of look behind you, you can anticipate after you've range trade the market, I'm going to have a pocket of low usage below me. At this point, if you're positioned of coming to this market fresh and new and you see this really deep pocket, you know this break of 148 is going to trigger a steep, rapid decline to 143. And I may even put in some more context to see, well, once it's filled in that pocket, and then what? And so this is where we are today. Here you see C. We're coming, it's pretty close to development. And I look behind me and I see if I break 140, I am going to break hard to 129. I would consider that a pretty deep pocket. So you can play for range trade, but your surprises in a market like this are going to be to the downside. So often you're going to get 70%. Sometimes you may get only 70% full, not 90% full or 100% full completion of a bell curve before the new leg of the move will continue when you have so many pockets of low usage behind you. And so this is what we saw happen. It did spend some time developing between 43 and 50, finished that final phase of development. You were ready, positioning yourself towards that top of value, or you took that breakdown under 140 in your mental strategy, and here we sit today. We broke hard toward 129. You can see there's this pocket between 36 and 40. It could fill in at this point. Breaking over 36 ledge would be probably a trigger to take you up to around 140. A favorite strategy for me, because I think we're in a pretty big macro decline into the future, would be to hit 140 or 143 if it got up there again over the next 6 months and position myself for the ultimate decline. So just to finish up, I thought it would be interesting to show you some example of how this method works on some short-term spreads. I've done whole presentations on just stocks as well and how to build portfolios from top down, starting with like a market view, then sectors, then industry analysis, and then ultimately drilling down into individual stocks. And this data format can be applied to any time frame and actually really any instrument. So that's why I thought, well, let's take a look at a crude spread, a calendar spread. And this is more short term. This is a recent synthetic profile chart of a calendar spread. It's long Ds 14, short Ds 15. And we took a completed profile at A, which you can see on the left, and I combined some history data going back behind it to August 26 to give us some context. And when doing it, it revealed this pocket of low usage above me. So there's this pocket from 560 to 640. You can already see the market creeping over that ledge, and we have a sense that we're about to rally. We're going to go to 640, and then we're probably going to spend some time in development. Once it does that, you can see how on the left how it's split out. You had chances to buy the bottom, sell the top, and then at that point, we needed somewhere towards the end of this development, we really had to put it in some sort of context. So let's see what A, B, and C look like all combined. And this is pretty close to today, where it's going to sit in the context of past development. And now this breaking of the ledge at 480, that's kind of triggering, this is triggering the idea that we're ultimately going to test 350 in this spread. I took ABC profile at the top, I put it into its context again. Now I'm creating a bell curve out of a larger underdeveloped bell curve. So what we've covered is really just a decision support tool, and we've talked about market profile structures and how you see the market and how this is a database. We talked about how this is a way to see market consensus and how far along we are on the way in that negotiation process. And then we've talked about how markets move from high usage to low usage, and we're always trading underdeveloped bell curves to give us our edge in the market. I also just wanted to mention, I really have just enormous respect for this method of organizing data with market profile, and it was really the genius of Pete Stoudemire, its creator, who recognized that the auction self-organized into a bell curve, and he really understood all of its implications for reading the market. And I recognize him as my mentor and someone I believe has just made an enormous contribution to our industry. And so I thank you all for participating today. I enjoyed putting this together for you. If you have any further questions about it, you can feel free to connect with me. I may be giving more advanced workshops in the future, and this is the completion of my formal part of my presentation. I'm open for questions if you have any.
Hi, Robin. This is Tom. Then we have a couple of the same questions that came in, so I think I'm going to pop in here first, and that's the idea of applying market profile for intraday trading.
It's really the same. That's why I showed you that crude spread. I think what you really have to be careful of is getting locked into the trees and not seeing the forest. And this is happening in our industry a lot. We're just getting micro time frame. And it's okay if you are doing a micro time, intraday trade, and you happen to be at the bottom of value of an underdeveloped bell curve. Then you've probably bought yourself time. But if your intraday trading is going on at the tip of a completed bell curve that's ripe and ready to move in the context to the upside, and your little underdeveloped bell curve in your world, you're selling the top of value, you might get hammered. And I think those are the times that it would be very good to always have a long-term profile up and behind you to give you some context for the time you have in that short-term trade.
Also, do you
where are
volume?
You in the universe kind of thing?
Another question was about incorporating volume analysis in with your market profile.
Yes, they're both great. One's not better than another. I've done a lot of testing, and what I found is usage charts is what I call them. They really tell you the psychology of where people are accepting price. Volume isn't exactly the same because you might not have usage over time is telling you a market's willingness and psychology of acceptance toward that price as being fair. So what I've noticed in my own study is sometimes markets will fluctuate between the usage price and the highest volume price. Sometimes they correlate, and those are pretty powerful moments. And sometimes they are in contradiction to each other. And I would say it's a coin toss. From my analytical studies, it's a coin toss which one wins over. Is it the usage chart that pushes it through the high volume chart or vice versa? So you would need some other technical analysis or your own studies to tell you which one.
Okay, and we have another question along the lines of, they're actually asking about technical analysis, but I think within the concept of your work here on the market profile, any large difference you see between equities and commodities?
Well, I use this context to build and do my portfolio consulting for my clients, and I love market profile for stocks. Because of these long-term contexts and because it's much more of an investment strategy that you do when investing in stocks, it is an incredibly powerful tool. I would say it works the same. I don't really use market profile for short-term analysis for stocks, but I could, or week, and when I say that for stocks, I'm talking about a week or under. But for commodities, you can certainly do shorter-term profiles. I think you've got the liquidity and the volatility more in commodities that you could use short-term profiles for.
Okay. Well, we've come to the end of the time allotment for the webinar itself. There are a few other questions in here that I'll forward to you directly.
Okay.
People, CQG customers who would like to get a trial of a market profile, you can get a contact a salesperson, and if you're interested in more understanding about using market profile, our product specialists can also assist you in the understanding how to use market profile. Actually, I've been told I have a little bit more time here. One question I had: do you trade split profiles during the day?
Yes, absolutely. You saw my split profiles, and when you say split, you mean the very first chart that I showed in terms of every single letter split out? No, but I'm always splitting my profiles to see where the new directional move has just come out of. Within profiles, there are multiple profiles, so I like to split those out and trade those for development, and then continue to manage the bigger profiles development in terms of the context of the small profile I'm trading.
Okay, we had someone ask about the market profile being set to 2 standard deviations in CQG. In the display preferences for the market profile chart, you can actually put in whatever value you want for the percent distribution. So if this person wants to see 1 standard deviation, they could change that value, correct?
Sure.
Okay. And someone has asked again about if this recording is going to be available. Yes, this webinar is being recorded, and we will be sending out an email to all registered users, and it'll be posted within the next 48 hours, so people can watch this again for picking up on anything they might have missed. Let's see. I guess one other question I can get to right now is this: do you have like a mathematical way of defining when a bell curve is completed?
Well, it's not exactly a science, but it can be objectified to a great degree. Today I tried to show you visually what underdevelopment looks like. So there's no mistaking underdevelopment. I showed you many, many charts. So recognize underdevelopment. That would be your first start. Then when a profile is pretty much 70% full, I call that developed. I'm already off to the next storyline, which you got to get your prior context in, and forget about trading the last 30% of a profile to get developed. Start thinking about where's my edge, and where do I have to position myself during this last 30% of development. So you're really always developing, always trading a very underdeveloped bell curve. So that's easy to recognize.
Okay. Then one last question then would be, is there kind of a general amount of time you would let a profile develop during the day for any kind of day trading then? Do you like wait the first hour or something along those lines, I guess is the question.
No. No, because we're really talking market time. So the day is very artificial. So you might want to start every day with yesterday, or something new might have started at 2 o'clock or overnight. So you have to make sure that you find the completed bell curve, split the new move out, and trade that profile.
Okay. Okay, I'm going to go ahead and we're going to, this is the end of our webinar now. And again, some of these other questions I'll forward on to Robin herself. So I want to say thank you again very much.
Yeah, thanks,
Robin,
Tom, for hosting.
Yeah, my pleasure. And again, you'll be receiving, an email will go out with links to the recorded webinar for reviewing again then. So thank you, everyone, for your time. And again, thank you, Robin.
Great. Good day, everyone.